It's 2008. The stock market is in freefall. Billions are being wiped out every single day. Banks are collapsing. People are panic selling everything they own. The news is screaming that the financial world is ending. And Warren Buffett? He's buying. Not just a little. Billions of dollars, while the rest of the world was running for the exit. So what does the world's greatest investor know that most people don't? What goes through his mind when the market crashes? And why does he consistently turn crisis into opportunity? Today, we break down Warren Buffett's exact advice when the stock market crashes, the principles that have made him one of the wealthiest humans in history. Stay until the end, because the last lesson completely changes how you think about money. This is probably the most famous thing Warren Buffett has ever said about investing, and it sounds simple, but almost nobody actually does it. Here's the psychology behind it. When markets crash, fear spreads like wildfire. People look at their portfolios dropping 30, 40, 50%, and their brain tells them one thing: get out. Save what's left. But Buffett sees it differently. He's not looking at the panic. He's looking at the price tags. When great companies go on sale, companies with strong earnings, loyal customers, durable business models, he doesn't cry. He pulls out his checkbook. Think about it like this: if your favorite restaurant suddenly started selling their best meal for 50% off, would you stop going? Or would you go more often? Buffett treats stocks the same way. A market crash isn't a warning. For him, it's a clearance sale. The key takeaway? Your emotions are your biggest enemy during a crash. The investor who controls their fear will always outperform the one who doesn't. One of the most common mistakes investors make during a crash is waiting for the perfect moment to buy back in. They sell everything, wait on the sidelines, and tell themselves, "I'll jump back in when things stabilize." Buffett has a brutal response to this mindset. He once said, "I never attempt to make money on the stock market. I buy on the assumption that they could close the market the next day and not reopen it for 5 years." Let that sink in. He's not playing a short game. He's not checking stock prices every hour. He's not waiting for the right signal. Because here's the reality: no one, not analysts, not hedge fund managers, not economists, can consistently predict when the market will bottom out. The people who try to time the market almost always miss the 10 best trading days of the year, and those 10 days are often what determines whether you made money or lost it. Buffett's lesson: stop trying to predict. Start preparing. Have your watch list of quality companies ready. And when prices drop, you buy, not because the market has recovered, but because the business is fundamentally sound. During market crashes, you'll hear a lot of voices telling you to buy the dip on everything: crypto, speculative tech stocks, meme stocks. Buffett's response? He's not interested. His rule is ironclad: never invest in a business you cannot understand. This is why Buffett famously avoided the dot-com boom of the late 1990s. Everyone thought he was out of touch. Then the bubble burst, and Berkshire Hathaway came out virtually unscathed while everyone else lost fortunes. His logic is simple: if you don't understand how a business makes money, you won't know when to hold it, when to sell it, or whether a price drop is a buying opportunity or a warning sign. When a market crashes, this principle becomes even more critical. Stick to what you know. Stick to businesses with consistent earnings history, strong brand or competitive moat, simple, understandable products or services. Buffett's biggest positions, Coca-Cola, Apple, American Express, aren't accidents. They're companies he understands deeply. His advice: during a crash, don't go chasing complex, speculative assets. Double down on what you know. If you ask Warren Buffett what his favorite holding period is, his answer is always the same: forever. Most retail investors think in days, weeks, or quarters. Buffett thinks in decades. When the market crashed in 1987, 2001, 2008, and 2020, each time, the media declared it was over. Each time, the market recovered. Each time, patient investors who held quality businesses came out ahead. Look at this pattern. Every single major market crash in history has eventually recovered and gone on to reach new highs. Every single one. The S&P 500 has returned an average of about 10% annually over the last century, including every crash, every recession, every war, and every crisis. Buffett's lesson: time in the market almost always beats timing the market. When prices drop, instead of panicking about where the market will be in 3 months, ask yourself, where will this company be in 10 years? If the answer is still growing, profitable, and dominant in its industry, then a market crash is your opportunity, not your threat. Here's something many investors don't realize about Buffett's strategy. He almost always keeps a massive amount of cash on hand, what he calls dry powder. Berkshire Hathaway has, at various points, held over $100 billion in cash reserves. People criticized him for it, saying he was missing out on gains by sitting on cash. Then the market crashed. And while everyone else was scrambling to survive, Buffett was shopping. During the 2008 financial crisis, he invested $5 billion in Goldman Sachs and $3 billion in General Electric, both at extremely favorable terms, because he had the cash ready to deploy when nobody else did. His lesson for regular investors is this: a market crash is only an opportunity if you have money available to take advantage of it. This means, build an emergency fund before investing heavily. Don't invest 100% of your capital, keep some liquid. Avoid using leverage or debt to invest in volatile assets. Preparation is the difference between watching a crash happen and actually profiting from it. During a market crash, the noise becomes deafening. Financial news channels run 24/7 doom coverage. Your Twitter and Reddit feeds fill up with predictions of total collapse. Your friends and family are panicking and calling you to ask if you've sold everything yet. Buffett's advice is direct: turn it off. He once said, "The stock market is a device for transferring money from the impatient to the patient." Every panic seller in a crash is essentially paying a patient, long-term investor. Buffett doesn't watch CNBC to make investment decisions. He reads company annual reports. He studies business fundamentals. He ignores Wall Street forecasts almost entirely. Because here's the truth: the media profits from your fear. Their job is to keep you watching, clicking, and reacting. More panic equals more viewers. That doesn't mean the panic is justified. Your job as an investor is to separate signal from noise, to ask not, "What is the market doing today?" but, "What is this business worth, and is it trading below that value?" That discipline, ignoring the noise, is one of the hardest and most profitable things you can do as an investor. Buffett's mentor, Benjamin Graham, introduced a concept called Mr. Market, and Buffett has referenced it throughout his entire career. Imagine the stock market is a business partner named Mr. Market. Every single day, he knocks on your door and offers to buy your share of the business, or sell you his, at a price he names. Some days, Mr. Market is euphoric. He offers you a crazy high price for your shares. Other days, he's depressed and scared, offering to sell his shares to you for almost nothing. Here's the thing: you never have to accept his offer. You can ignore him completely until he offers you a price that makes sense. Most investors do the opposite. They let Mr. Market's mood control their decisions. When he's euphoric, they buy at peak prices. When he's depressed, they sell in panic. Buffett's lesson: use Mr. Market. Don't let him use you. A market crash is simply Mr. Market being irrationally depressed. It's your signal to look for bargains, not to mirror his panic. So let's bring it all together. When the stock market crashes, Warren Buffett doesn't see a disaster. He sees a test of discipline, preparation, and long-term thinking. His advice, distilled: 1. Be greedy when others are fearful. 2. Stop trying to time the market. 3. Only invest in what you truly understand. 4. Think in decades, not days. 5. Keep cash ready so you can act when others can't. 6. Ignore the noise and focus on business fundamentals. 7. Be the master of the market, not its servant. These principles didn't just make Buffett rich. They kept him rich through every crash, recession, and crisis of the last 70 years. The next crash isn't a question of if, it's a question of when. And now you know exactly how to handle it. If this video gave you value, smash that like button, subscribe for more investor mindset content, and drop in the comments, what's your strategy when the market crashes? I'll see you in the next one.